Hi everyone, and welcome to this new webinar. I'd like to extend a very warm welcome to all of you. Thanks, guys, for being there. Today we have a very important webinar regarding fundamental analysis, which is going to be very interesting because this is a very important part or tool when it comes to analyzing the market. Understanding the fundamentals would simply help you to improve your profitability as well as understanding of how the market moves. Now, without further ado, let's get started. Um, we have some main points to cover. First of all, the definition of fundamental analysis, and then we're going to make like a comparison between fundamental analysis and technical analysis. So, fundamental analysis versus technical analysis. And then we're gonna um, simply explain some important tools regarding fundamental analysis and some very important economic indicators that would help us to understand how the whole lot thing works. First of all, fundamental analysis. What is fundamental analysis? Fundamental analysis is one of two main methodologies for evaluating and forecasting movements in currency exchange rates, as well as for the prices of securities, commodities, or any other publicly traded asset or financial derivative. The other primary method used by traders is known as technical analysis, and we would cover this later, actually, in the comparison that I mentioned earlier. And actually, this could be simply covered in detail, maybe in another webinar or something like this, because it would take too much time to cover everything when it comes to technical analysis. A very deep, a very complicated um, tool. So, technical analysis simply focuses on the market um, observables like the exchange rate or the price of an asset, the volume traded, and open interest when it comes to futures. The basic skill involved in fundamental analysis in forex trading requires an analyst, why, to determine how a currency will react to macroeconomic events and central bank monetary policy shifts, political and social news from the currency's nation of origin when compared to the other currency in a currency pair, because we would usually have two currencies. The currency pair would consist of two currencies, the base currency and the counter currency. So it's like two nations, one nation versus another. So this is simply how it goes. Um, so the thing here is that maybe if we are talking about like the eurozone is a nation that does consist of many nations. Okay, it's a group that does consist of many nations. So in order to be able, for instance, to understand what is going on in the euro area, you will need to uh, see the whole picture, the entire regional economy as a whole. This is something that is really required to make an accurate fundamental evaluation of the currency. Okay. Basically, currency pairs tend to react sharply to the releases of economic data and current geopolitical and local news events, especially when the results differ significantly from what was originally expected by the market participants. Now, I'm going to show you something that is really interesting here. This is the website of Point Trader Group. We have here newsroom. The newsroom, it has economic calendar, what we call the economic calendar. Here you're gonna find all the releases of the economic indicators that would help you. Now, they are all scheduled for like 1 month or more than this. You can just select the period that you want to um, watch. For instance, this period, this part of the website would show you that you want to watch the current week or the previous week or the next week, current month, previous month, next month. It's up to you. See how it's gonna work for you and do it the way that you want. So it simply provides the times and dates very accurately, the time and dates of the releases actually. Okay, this makes performing a fundamental market analysis of economic releases and events and their effect on currencies valuable when determining the direction of the market and the level of future exchange rates. Now, I'll give you a very simple example. There's a person by the name of Michael, for instance, and you want to follow him, to watch him, in other words, to expect his future movements, to predict what's going to happen to do in the future. Now, first of all, what you're gonna do is that you would collect information about this person, maybe from the neighborhood or maybe some people who know him or whatever. It takes many. I mean, there are many ways to do so, but let's put it this way: you are going to collect um, information, as much information as you can, so that you can expect what he's going to do. Now, it is simply three stages: past, present, future. To know what to comprehend or maybe to have an idea about what he was doing in the past, you would need to collect data, to ask people about him, and then you would take this information and put it into the present, and you're going to compare yourself. You're going to do this yourself. You're going to see how you maybe you need to get in touch with him, to meet him face to face, face in person, so that you can compare what happened before, okay, with what he's doing right now. In this case, you're going to see the past happening in front of you in the present, and you can make things even better, um, evidence even better, and they're going to work for you. And based on this, in the future, what you're going to do is that you would use both past and present together to expect what is going to do in the future. This is simply how it works in the FX market when using any of these methodologies, whether technical analysis or fundamental analysis, doesn't matter. The same way it could be adopted. Nothing wrong with this. But when it comes to collecting data information regarding a specific currency pair, this is, I would say, a little difficult than using technical analysis because collecting data is not an easy task. It takes time. It needs a very accurate person so that you are able to understand the state of a currency pair easily. It takes time. This is the thing. Now, let's make a comparison between fundamental analysis and technical analysis. Fundamental and technical analysis are primary ways traders review economic and market conditions to determine future direction. So we're going to use whether fundamental analysis or technical analysis, or maybe both of them, to determine the future exchange rate of a currency pair, the Euro USD, GBP, GPY, whatever that you want. While the focus of fundamental analysis generally remains on news, sentiment, and releases of economic indicators, technical analysis, on the other hand, relies on the price and price movements of the underlying asset or the exchange rate of a forex currency pair. In addition to looking for patterns on charts of the exchange rate itself, technical analysis, uh, or maybe I would say we as technical analysts, uh, would also compute and use a number of the other related technical indicators to determine directional trends and momentum in currency pairs. This would include oscillators like stochastic oscillator, like moving averages, like volume indicators, and so on and so forth. So this is what it takes so that you are able to uh, use technical analysis. Technical analysis also differs considerably from fundamental analysis and may point to a different directional view for a currency pair, but the fact remains that technical analysis provides one of the best objective tools available to the forex trader for quickly assessing a market and trading profitably in the short term. Nevertheless, technical methods have their drawbacks, okay, disadvantages, I would say, including the fact that pretty much every other trader in the world is looking at the same exchange rate data. This can produce like a herd-like effect when a classic pattern shows on the chart or starts to develop on the chart. This would simply sometimes, if the pattern fails, this would simply hit your stop loss. Okay. So, as I told you, it's good. At the same time, it has its bad side or downside. Fundamental analysis has traditionally been better suited for traders who operate on a longer time frame. The method involves analyzing a nation's overall economic strength, its interest rates, central bank monetary policy, money supply, um, trade and current account balances, as well as the country's overall political stability. Some fundamental traders use short-term news trading strategies that generally operate right after the release of a major economic number, or maybe central bank rate decision, or news of a major geopolitical event such as a war or a natural disaster. Regardless of which analysis methodology best fits a trader's trading plan, research remains a key element in successful fundamental or technical forex trading. The most traders find a working knowledge of both analytic methods beneficial. So you might want to use you perhaps use both of them together so that you are able to have a better understanding of the conditions of the market. So you're gonna maybe read some news or maybe follow some economic indicators, some releases, the Central Bank of America maybe, or the Central Bank of England, whatever, and just have an overall view of what's happening in this current country compared to the other country that you have in the pair. For instance, we have the Euro USD. So we are talking about two nations now, the European nation and the and America. So the comparison would be done between these two nations. You will be following everything that is related to the American economy or the American nation uh, in general, and you're going to be following what's happening in the Eurozone as well. in general. You want to take the just like the most important things that are moving the market or maybe causing the market to move this way. Uh, Maybe some important speeches made by central banks members, or maybe some important releases that had to do with inflation or maybe interest rates or whatever. All of these things together, put together, would make the view much clearer. Okay, this is how it works. Um, okay, so you can use both of them. Nothing wrong with this. While research and analysis is just one key element for forex trading, money management aimed at what you would say preservation of capital that can be adjusted, that can be used as important to traders' long-term success. Okay. This is going to be very important. I mean, it's not only about analyzing the market, understanding what's happening in the market from a technical point of view or maybe a fundamental point of view. No, you're going to use both of them. I mean, if you are aware of what's happening in the market and you don't have a proper money management strategy, you're going to lose eventually. So it takes, I mean, it's like a triangle that has three sides: fundamental analysis, I would say, technical analysis, and money management, psychological management as well. All of these put together would make a very successful trader. So, what are the tools of fundamental analysis? The most useful tools for fundamental analysis consist of the economic calendar that I'm showing you right now. Here in front of you, you can see the economic calendar of Point Trader Group. There's like a description here. The economic calendar covers the results of the most important global economic indicators on daily and weekly basis. It also provides their times and dates very accurately. And as I told you, but here I'm going to mention some. I'm going to clarify something that is really important. Okay, here as you can see, we have some like colors here. I think I can go to this current week. Okay. Now you can see some colors here. This is white, and this is like gray, and this is like, I think this is orange. We also have some red here. Okay. Okay. All of these colors would indicate a different um, view of this indicator. What do I mean by saying so? I mean the importance of this release. Now, the lowest when it comes to the importance, now, the lowest is the gray. This has low impact on the market, very low impact on the market. The orange has a medium impact on the market. The red has a very high impact on the market. You know what I'm saying? So this is simply how it works. Now you're gonna have uh three tabs here: actual, forecast, previous. The actual is what we are waiting for. The forecast is what the biggest um, entities in the world are forecasting or expecting. Okay. And last thing is the previous. This is what we're going to be comparing with when it comes to the actual. So if we have a release, for instance, okay, here for, I mean, I mean, because due to the holidays, we don't have too much data. So we have the unemployment rate that comes from Japan. So as you can see here, the actual is 2.5. Okay, the forecast 2.6, the previous 2.5. Now this number is green because when employment is decreasing, this is going to be a good thing for the economy, for the whole country, actually. So the forecast was 2.6. Now the actual is less than the forecast, just like the previous, but still green because this is less than what the market is expecting. Now the market moves very sharply to the upside or to the downside. The market simply gains value or lose value based on one thing: the actual versus the forecast. If the actual is higher than the forecast, okay, this this depends entirely on the release itself. For instance, the unemployment. The unemployment is something that is really bad for the economy. Higher numbers mean a kind of that people are not working, and this would affect somehow on the economy. Lower numbers would mean that more people are working, and in this case, this would be great for the economy. So it depends on the release itself. For instance, the inflation rate. If the number of the inflation rate is going higher, this is very bad for the economy. If the number is going down, this is very good for the economy. The GDP numbers, if they are going down, this is very bad for the economy. If they're going higher, this is very good for the economy. Okay, you know how it works. Sometimes uh, this methodology or this method I mean, is changed. Why? Because of the release itself. Sometimes. Why? Maybe if we want to speak about something about uh, uh, the industrial production, for instance, higher numbers are great for the economy. Lower numbers are very bad for the economy. You know what I'm saying? So this is simply how it works. When it comes to unemployment, higher numbers are very bad for the economy. Lower numbers are very good for the economy. So it depends on the release itself. Just keep this in mind because this is not gonna be like your ultimate rule to follow. Um, higher numbers, higher numbers don't mean in general that they are good. Lower numbers don't mean in general that they are bad. Okay, it depends on the release itself. I mean, just use your mind. Just use your mind and think about the release itself. Or maybe you can have a definition, or maybe search on the internet on the Investopedia to find out whether this is going to be okay for the economy or not. This is going to work very well for the economy or not. It depends on the release itself, as I told you earlier. Okay, guys? So this is simply how it works. Okay, so do you have any questions before I carry on? We still have too much to discuss today, but I'll go through the most important things. Maybe if we need another part, we can schedule, or we can conduct a new. Okay, so let's continue. Um, Now, when it comes to fundamental analysis, we must mention something. I mean, we will never forget this for sure. We must speak about or discuss the economic indicators, fundamental analysis indicators. Some of the major fundamental analysis indicators used by currency traders to determine the overall strength of a country's economy and potential exchange rate forecast include the growth rate. It's called the gross domestic product or GDP, as I mentioned earlier in our examples, employment data, trade balance, retail sales, and inflation numbers like the consumer price index or CPI. Some of them may also give traders an idea of what a future lease could look like, such as GDP or survey numbers. Furthermore, some economic indicators often lead other indicators in signaling when an economy is turning up or down. The leading fundamental economic indicators include purchasing manager surveys, producer price index or PPI. I mean, you might have a shortcut for each indicator, like consumer price index is called CPI. Producer price index is called PPI. We also have durable goods orders numbers. Let's take a look at some of the key fundamental economic indicators used by Forex traders. First of all, we have employment reports, including the unemployment rate, the number of jobless individuals applying for services, payroll levels, and other job related data. Anything that has to do with employment. Trade balance is simply the difference between the country's imports and exports, which has a direct effect on the demand for the nation's currency. Okay. How it works, a defect would mean the country is importing more than exporting, while a surplus would indicate more exports than imports. Okay, so when uh, exports exceed the number of imports, this means that the country has what we call like a um, surplus. Okay, any questions on this? Okay, guys. So a deficit, the difference between a deficit and a surplus is simply measured this way: whether exports are more than imports or imports are more than exports. This is how it works. We also have GDP. GDP is simply change in a nation's growth domestic product that can have notable effect on the currencies, or maybe the currency of a specific country. If we have a sharp increase in GDP, this would indicate strength in the economy that could uh, um, like that would have its currency appreciated. Okay, especially if the market anticipates a possible interest rate hikes. More GDP means that the economy is heating up, and this would in turn means that they would adopt a very tightening policy, and in this case, they would simply raise interest rates. This would be okay for the currency. More people would be willing to buy this specific currency pair because of uh, the high return that they would receive. Okay. Uh, we also have we also have what we call CPI. The Consumer Price Index shows the level of prices of products on a consumer level and is a key inflation indicator. Controlling inflation is one of the first tasks of most major central banks, so CPI change can directly influence monetary policy. An increased inflation could indicate an interest rate raise, while lower consumer prices would indicate lower benchmark interest rates. Well, since we're talking about inflation, then we have the PPI, the Producer Price Index, that measures what manufacturers are paying for their material before making a finished product. This number affects a nation's currency because a higher PPI number suggests higher future consumer inflation, while a lower number indicates the opposite. Why? Because if they are producing a product and they are using material that are not cheap, this would simply be reflected on the final product at the end, eventually. Why? Because this is how it works. For instance, a product cost that would cost them like $1, okay, because of the material that they have used in producing this product, would simply be reflected on the market eventually, because the consumer would buy this product and will pay for it more money than he's supposed to be doing. And in this case, inflation would go higher. And this would simply mean that in order for the central bank to control the phase of inflation, just in case we have a phase of inflation, because inflation simply means that this is an over uh, all increase in prices, not only one product. I mean, if we have an increase in the price of one product, this doesn't mean we have inflation. But if everything around us is increasing in prices, then in this case we have inflation. Okay, guys. We also have PMIs, the Purchasing Managers Index surveys that actively would help you to increase your trading. Believe me. Um, this would reflect the activity of purchasing manager and can be a leading economic indicator. Purchasing manager generally are the first to know of increases or decreases in future production that can indicate strength or weakness in the manufacturing sector. You know what I'm saying? Okay, guys. Central bank monetary policy. This is another part. I'm done with the most important release indicators. Now, each major economy has a central bank that typically manages its currency. benchmark interest rates and money supply, central bank activities, and speeches by central bank officials are closely watched by fundamental traders for finding a way to understand what's gonna happen in the market, for uh, trying to comprehend what's gonna happen when it comes to the shifts of the future monetary policy. Okay, when it's gonna shift. Okay, guys. So when it comes to central banks, I'm gonna mention some maybe terminologies that are going to be very helpful to all of you. We have interest rate decisions. I think you may, one way or the other, you may have heard of something like this: interest rate decision. The amount of interest charged by a central bank is extremely important to the valuation of a nation's currency. If a country's central bank sets a high interest rate, okay, we would have uh, we also would have like other factors such as political instability, for example. The nation's currency tends to attract foreign assets for countries from countries with a lower interest rate. This is simply how it works. Just in case you have a good political situation in the country. Central bank rate statements, the conference of the conferences of the press conferences of the central banks are very important as well. Most central banks issue a statement after rate release describing their monetary policy committee voting and the reasons the rate was changed or left unchanged. The statement could affect the market if the policymakers' voting was unexpected or if the central bank has a more dovish, we would say, or hawkish or whatever for the future rate decisions. Policymakers and central banks officials' speeches are very important. The content of a speech by the president, governor, or the official of a major central bank can sometimes give indications of the bank's future monetary policy, which will often affect the country's currency. Other key policymakers include the voting members of the central bank's monetary policy committee, and while their speeches may not carry the weight of the of the central bank governor, they could also have an impact or an effect on the country's currency depending on the content of the speech, the tune of the speech. This is what we would usually be saying, the tune of the speech. Asset purchases um, and something that's really important as well. Take it easy. Okay, so we have asset purchases and quantitatives easing. This is going to be really important. This is simply the amount of money a central bank uses to purchase debt, securities, and other assets to support a weak economy. Increase or decrease in the amount of uh, the money measures, or maybe in other words, I would say, can have a significant effect on a nation's currency because changes in asset purchases can indicate a change in the interest rate and money supply. The last thing that we have today, we have many things to be discussed, but due to the limitation of time, time is running out. So I think we this could be enough. Okay. Geopolitical. The last thing that we have today is the geopolitical events. If we have wars, we have elections, we have power changes, we have natural disasters, all of these things would simply have a great effect on the impact on the market. Okay, keep this in mind. They would simply affect the market very sharply, either in a very bad way or in a very good way. Okay, so thereby the currency of this country would appreciate or would lose value. This is simply how it works. Okay, guys, so I hope that you have enjoyed the webinar of today. I hope that this webinar has beneficial to all of you. Um, has been beneficial to all of you. Thanks, guys, for being there. Thanks for joining us. Stay tuned for our upcoming webinar and bye for now.